Welcome to the De-Risk Daily Brief. It's Friday, November 7th. Yesterday, we talked about a great macro divergence, pulling markets in opposite directions. Today, that divergence has a powerful new catalyst. A major geopolitical thaw is happening in the middle of a macroeconomic deep freeze. The central theme is a market getting exactly the good news it wanted on trade, but being too gripped by domestic fear to act on it. Overnight, we got confirmation of a significant de-escalation in the U.S.-China trade war, with Beijing removing retaliatory tariffs. This should be a clear risk-on signal, yet U.S. futures are stubbornly flat, the dollar is struggling below the 100 mark on the DXY, and most tellingly, the VIX has jumped back above 20. It's a picture of profound cognitive dissonance. The market sees the good news, but feels the underlying fear. Alex, this is a fascinating setup. We have a huge geopolitical de-risking event that seems to be falling on deaf ears. How is this conflict between trade optimism and macro anxiety playing out globally?
It's a fantastic question, Sarah, because that conflict is the only story that matters today. Let's start in Asia, the epicenter of the trade news. The Hang Seng in mainland equities should be soaring on the tariff removal. Instead, we saw a tepid, low-conviction rally. The technicals are strong, we've noted the golden cross pattern, and now there's a fundamental tailwind. But the buying is hesitant because global investors are more focused on the risk of a U.S. slowdown than a China rebound. Similarly, Japan's Nikkei is in a technical uptrend, but remains bogged down by its own domestic policy debate at the BOJ. The positive regional news is being heavily discounted by global fear. That story of preoccupation carried straight into the European session. The DAX and FTSE are also technically bullish, but they're completely ignoring the China news. Europe is consumed by its own divergences. In the UK, markets are still digesting that razor-thin 5-4 vote at the Bank of England, trying to game out whether a December cut is truly on the table. In the Eurozone, you have the ECB talking tough on inflation, while its largest economy, Germany, is stagnating, with business confidence continuing to deteriorate. Europe simply doesn't have the bandwidth to price in a positive global trade story when its own house is in such disarray. And that brings us to the U.S., where this conflict is most acute. The tariff news is being completely neutralized by two things: the ongoing government shutdown, now in its 6th week, and a barrage of conflicting economic data. We have dueling private jobs reports, one showing a gain, the other a massive loss. We have a strong headline ISM services print, but the employment component within it is contracting. This paints a picture of an economy that is resilient on the surface, but rotting from within, particularly for the consumer. This paralysis is evident across every asset class. In fixed income, the 10-year yield is trapped. The China news is inflationary and should push yields higher, but the shutdown and weak labor signals are screaming recession, capping any move. The bond market is simply frozen. The currency market is the main release valve. The dollar index is weak because traders are ignoring the global benefits of the trade deal and focusing exclusively on domestic dysfunction and the rising probability of a December Fed cut. The DXY breaking below 100 is a significant psychological blow for dollar bulls. Commodities are telling the story perfectly. Gold has climbed back above $4,000. It's acting as a pure safe haven asset, rallying on the weak dollar, Fed cut bets, and political uncertainty, completely ignoring the risk-on trade news. Crude oil is its mirror image. WTI is struggling to hold $60, crushed by Saudi Arabia cutting its prices to Asia, a clear signal of demand destruction and another U.S. inventory build. The market is pricing in a slowdown, full stop. And that brings us to the VIX, which is the ultimate tell. For volatility to be rising back above 20 on a day with major trade breakthrough tells you everything. Fear is winning. The market is more worried about a U.S. recession than it is optimistic about global trade. Back to you, Sarah.
So the market is effectively saying the U.S. domestic situation, both political and economic, is now a big enough problem to outweigh a major positive shift in global trade dynamics. With the market trapped in the stalemate, today's official U.S. jobs report for October becomes the critical tiebreaker. The private data has been messy and contradictory, so non-farm payrolls, the unemployment rate, and especially average hourly earnings will be the definitive print. A strong report could force the market to reconsider its recessionary fears and finally price in the good news on trade. A weak report, however, would validate the VIX's move, cement expectations for a December Fed cut, and likely send the dollar even lower. Beyond the jobs data, we'll be watching the preliminary Michigan consumer sentiment for November. Given the narrative of a weakening consumer, this number carries extra weight. And, of course, we have a full slate of central bankers speaking, including the Fed's Jefferson and Mirren, who will be giving their first reactions to the payrolls data. It's a day where the market is desperately searching for clarity. And for once, the data might actually provide it. We'll leave it there. Thanks for listening to the De-Risk Daily Brief. Disclaimer. This podcast is for informational purposes only and does not constitute financial advice. All investment decisions should be made with the help of a professional.